Hannah Kesler.
This gal started her own bank at the age of 18, and then you became a self-made millionaire by the age of 24?
I did.
Hannah Kesler is a money mentor.
She's known as the single millionaire chick.
With advice on how to stop living paycheck to paycheck.
Money starts with your mindset.
How you think about your money is going to greatly impact how much money that you have.
I grew up in a town called Olathe, Kansas. I'd be walking out of the door, going to school, and my mama would holler at me, "Hannah, make good choices." And I'd have to holler back, "Because the choices I make today will affect my future."
My parents, they did a very good job about teaching me as a child how to handle my money.
We have a lack of understanding when it comes to money.
If you want your kids to have money, you need to start talking to them about it while they're young.
I'm really second generation to this concept that's called the infinite banking concept.
And at 18 years old, my dad gave me the choice to start my own bank that then led me to becoming a millionaire by the time I was 24.
Now you've written a book to help tie it all together.
So the companion is really just teaching kids that, not specifically money, but really important life lessons.
Now being the owner of the Money Multiplier, I help serve over 17,000 clients in every state of the country.
Where can people get the book?
HannahKesler.com. Hannah spelled the same way forwards and backwards, Kesler with one S.
Also, I got my podcast show, the Money Multiplier Podcast.
And make good choices today, because the choices you make today will affect your future. Hello and good morning, my people. I'm finally getting my voice back. So I feel good. It's still a little mucusy over here, but we're doing great. We're sleeping, we're swimming in the ocean. I'm letting Mother Nature heal me and cure me. So I have an amazing topic that we're going to get into today, because this actually came from some conversations that I was having with some of my clients this past week, and even some posts that I've been seeing on Facebook where life insurance needs to stay in the life insurance lane and investing needs to stay within the investing lane. And for whatever reason, we're trying to compare the two products, okay? Because there's no one silver bullet. You'll hear me say that all the time. There's no one silver bullet out there that's going to be the magic solution to everybody's problems, okay? Everybody is different and everybody has different goals, different needs. You're in a different financial position than your peers, your family members. You and myself, we're different in our strategies of how we're building our wealth and keeping control of our money. So a lot of the times people are trying to compare the infinite banking concept to investments and the investment vehicles that are out there, and it's not. So that is why this whole episode today, life insurance versus investing, stop comparing the apples to the oranges. And I hear it all the time, "Hannah, why wouldn't I just go and invest my money?" And my response is always, because life insurance isn't trying to be an investment. So today we're really going to stop comparing the apples to the oranges and finally understand what each tool was designed to do. Because let me ask y'all, for my investors who are listening here this morning, good morning. Do you compare your savings account to your rental property or your Charles Schwab's brokerage account? No. Why? Because they're different. They have different purposes. So why do we consistently compare life insurance to the stock market? And I'll tell you this, I think this really came about when IUL products and VUL products started to come out on the market in the late 70s, early 80s. And we got to understand, why did the insurance companies even create these different products? Well, because back then, when interest rates were high, people were thinking, well, why would I want to store my money in a boring, guaranteed interest rate that I'm getting inside of my life insurance contracts? Because in my life insurance contracts, depending on the insurance company, the guaranteed interest rate is anywhere from 2 to 4% guaranteed. Why would I go do that when I can go put my money and my dollars into the market and that can hedge me a return of 8%? And then my mind wants to go down the whole rabbit hole of the differences between average rates of return versus actual rates of return, but we can have another conversation about that at some point. But they started to create these products because the insurance companies wanted to become, what's the right word? They wanted to be competitive, if you will, within the market and what was going on within the economy at that time. Now, let me be specifically clear here. When we're talking about the infinite banking concept, we are only using whole life insurance, not an IUL, index universal life, not a VUL, variable universal life. No. We're only using whole life insurance. And the reason we're using whole life insurance is because of the guarantees. I'm never going to tell you how to go invest your money, how to go make your money. If you want to have buddy conversations, I'm always here. I'm happy to tell you what I'm doing over here in my investment life to grow my wealth. But what I'm here educating on is, why are you storing your money in the specific places that you're storing it now? Why do you keep money down at the local bank? Why do you keep money in your 401k, your IRA, your qualified account? Why are you putting dollars into the stock market, giving it to Edward Jones, to Charles Schwab? Why are you doing that? So they're different lanes. One is an investment. The other one is where I'm storing my money at. And what I've really found the differences between the mindset of wealthy families versus the masses is, wealthy families aren't out there chasing returns. Yes, they want to build their wealth. They want to grow their wealth. They want to put their dollars into something that's going to make their little green men, AKA their money, their little green men, to work for them. But they're not out there chasing these unrealistic expectations on returns, because protecting the money that you have and keeping the money that you have is far more important than growing the wealth. Now, I said that. Is it far more important? It's important. I think they're both important, if you catch my drift. They're both important, and they both have a place within your portfolio and how you're building your family empire. But at the end of the day, I want to protect my vault. My father has always had this quote, and he teaches us kids. He says, pigs get fat and hogs get slaughtered. I want to be a pig and I want to get fat. I don't want to get slaughtered. So how can I protect and grow my wealth and be a fat little piggy instead of a hog and getting slaughtered every time I'm trying to go out and do an investment deal that may not be the best investment deal for me? So we got to stop comparing the apples to the oranges. So here's what I mean. Investing is a place where you can go and take your dollars to grow, to work for you. Your stocks, your real estate, starting your business, private lending, crypto. Life insurance is a place to protect the wealth. Inside of your whole life policy, this is a place that allows you to have liquidity. It allows you to have guarantees, tax advantages, tax-free growth. It allows you to have cash flow. It allows you to use this policy as a banking system. I'm not telling you to replace your investments. It's a place of where I can store the money, because my money has to be stored somewhere. I can leave it inside of my policies, my cash value whole life insurance. I could leave it down at the bank. I could leave it inside of a qualified account. I could leave it in my safe in my house and leave it as cash. And there's specific reasons comparing the different vehicles of why I personally store my wealth inside of my whole life insurance. And the reason I do that is because of the bullet points I just mentioned: the liquidity, having access to my capital when I want it, for whatever I want, having guaranteed growth no matter what's happening out there in the economy, and getting the government out of my hair, allowing me to grow my wealth in tax-free places instead of giving those gains to the government and to other people, aka your financial advisors who are taking maybe a 1% fee or cut off of your portfolio. I am in control, and it's going to grow guaranteed, no ifs, ands, or buts. And on top of that, what was life insurance even created to do? It's created to hedge against the risk of death. There is a death benefit. Death benefit is always, always, always on that whole life policy, whether you like it or not. And for some reason, just the public, we have this negative connotation to life insurance because we've always been taught as the masses, hey, don't spend a whole lot of money on life insurance. Just get the cheapest life insurance, buy the term, and then turn around and invest the difference. And then there's a whole rabbit hole that we could go down there too. Okay, go back and watch my past episode where I get into the differences between the strategies of buy term and invest the difference versus the infinite banking concept. But the whole life contract is simply the place of where I warehouse my money. And y'all, it is so simple. For whatever reason, it's a hard concept for us to grasp because we've always been taught, go out, go make your money. Go make your money. You got to go work to earn your money, trade your time for the dollars. And once you have that money, you go store it in somebody else's bank, Bank of America, TD Bank, Wells Fargo, US Bank. You go store the money in somebody else's bank, and then through that, go buy your investments. In the whole life contracts, when a policy is designed specifically for high immediate cash value, you're able to use this system as a warehouse of your money. And it's so basic, so easy. When I make those premiums into my policy, I call them premium deposits. And the reason I call them premium deposits is because anytime that I make that premium into my policy, there's immediate cash value made available to me. And so when I'm thinking about this system as my own bank, my own warehouse of wealth, I'm thinking about this as a deposit into my bank, my premium deposit. Is it a premium payment? Yes, it's a premium payment. But when I put money into an account that I own, I control, and I have immediate access to cash value, I think of this more as a deposit rather than a payment. Because when I think of payment, it's something that I'm never going to see. It's going towards an expense, a debt, something that I'm purchasing for myself, and I'm never going to see that money ever again. No, when I'm making those premium deposits inside of my policy, it's immediately showing up as cash value. And my definition of immediately is within 30 days. And when that premium deposit goes in, within 30 days, there's a cash value that's in there. And I can take that cash value out and I can go buy the expenses, my purchases, and even my investments. This is not to replace your investments. This is to elaborate, for lack of better words, your investment in what you're doing to continue to grow your money. Again, it's your warehouse of your wealth. Don't compare it to investments. I know a lot of us want to compare it to investments because it does grow in value. But when I think of an investment involves risk. It can go up in value and it can go down and it can lose value. There is some risk there. In a whole life contract, there is no risk. There's only one risk, I will say, because there's no risk. Why do I say there's no risk, Hannah? The reason I say there's no risk is because it's guaranteed to grow. You have a contractual guaranteed interest rate inside of that policy contract. Again, no ifs, ands, or buts. I got to receive my guaranteed interest rate. So the whole life contract is not my investment because it's guaranteed to grow. In an investment, it can go up in value. That's what we hope it will do, that it will continue to go up in value. But there's risk that it can go down and lose value. And that risk is based on external factors. How's the market doing? How is your borrower using the capital? Are they using it in a smart way? Okay, so like for my real estate investors, and if you're a private lender like myself, how is that borrower going to take your money, go and do the rehab on the house, and then go refi the property to then go pay you out? How are they using your money? You're putting that risk into them. Are they making smart choices? Are they actually doing the work on the house? Are they continuing to progress as they make the changes on that house so then they can continue on with their game plan to go and refinance it with the bank to then get you out of the deal, pay you out, and you're no longer in the deal? There's risk there that you cannot control. In a whole life contract, there's one risk, and the risk is you and how you use your policy. You could stop paying your premiums. That's up to you. Nobody can tell you whether to pay your premiums or not. It's up to you. You could stop paying your premiums. You could totally suck your policy dry and never pay your policy loan interest. That's up to you. You're in control of that and how you are using your own banking system. So the risk inside of whole life is you and how you use this system, not what the markets are doing, not what banks, the Fed, and other people are doing with your money, how they're investing your money. You are in control of this system. So when I was having a conversation with a gentleman who just hasn't been hanging around the campfire, because I get it, y'all aren't in this world day in and day out like I am, and he's an investor. He's like, well, hey, why would I continue to pay these premiums when I could go take this money and put it inside of another investment or asset class that could get me higher returns? And it's like, no. You're not thinking about this correctly. You're comparing the apple to the orange now. The whole life policy is the place of where you store the money, you protect the vault, and then through the policy, through the cash values, you can buy the investment. Okay, let's take it back to what Nelson Nash teaches us in his book, Becoming Your Own Banker. Okay, Nelson's talking to us about how we want to be in two businesses in our lifetime. The first business is the one that we're passionate about. It supports the livelihood, brings in the income, supports the family, okay? That's how we're producing the dollars. How do we go make the money? The second business is the business that finances everything throughout your life. And that's what this whole concept is talking about. Because again, I'm not going to tell you how to go make your money, how to invest the money. I'm teaching you, why do we store the money in the places of where we store it? And when I think about this, the difference is banks, I could go store my money inside of a bank. And what those bankers are doing is they're just taking my money and they're giving it to me or to other people, and they're making a good living off of that money. And if you ever forget about this, think about this. Here's my $20 bill here. If I want this $20 to go and compound at the bank, what do I have to do? I got to take my 20 bucks. I got to go down to the bank, hand them over the money. So they have the money, and now it's compounding for me. When I give my money to the bank, this money is now a liability to the bank. Why is it a liability to them? Because they have to pay me interest on it. You are receiving interest inside of your checking and savings account. Anywhere from 0.1% all the way up to maybe 4%. You may be receiving 4% inside of your checking or savings account, your CD accounts right now. So this money is now a liability to the bank. How does that bank turn this liability into an asset? They loan it. They give it to you or to other people to buy the things in life, to buy the houses, buy the cars, do your home remodels, maybe even credit cards. So they are turning this liability into an asset by lending it out to you or to other people and making good money on it. If I take this $20 bill, and let's say that I highlight it, I put my initials on this 20 bucks and I highlight my initials and I walk down to the bank and I say, hey, Mr. Banker, here's my $20 bill. If I go back in a day, a week, a month, a year from now, and I want my $20 bill back, do you think they're going to give me the same $20 bill that I highlighted and I put my initials on? No, because again, what are they doing? They're moving the money. They're moving the money. They're giving me another $20 bill, but they ain't giving me my same $20 bill that I highlighted and I put my initials on. There's no black box in the back of that bank that says Hannah Kesler, and they're putting my $20 into that black box, shutting the door, and then waiting until I come back and I retrieve my 20 bucks again. They ain't doing that. You got to get into the mindset of thinking like a banker. Think like a bank. A lot of the times when y'all are storing money down at the bank, you are taking the 20 bucks, you want to go and receive compound interest on it. You take the $20 bill, hand it over to the bank, and now I'm receiving that interest on the money. If you go back in a year, a month, a week, or a day and withdraw the $20 back to yourself, that $20 is no longer earning you interest anymore. This is the difference about the infinite banking concept. When I store and I take my $20 bill and I put it inside of my whole life insurance policy, I could withdraw the money out. Absolutely. You can withdraw cash outside of your policy, but I don't do that. Instead, what I do is I say, hey, insurance company, I want to take out this $20 bill from my policy. And I want to do it in a form of a loan. I'm going to take out a policy loan. So what that means is I'm putting my policy up for collateral. I'm taking that death benefit. That's what I'm collateralizing against, is my death benefit, what the insurance company is guaranteeing my beneficiaries at the time of my passing. Insurance company, I don't want to withdraw the money. I would rather take out a policy loan. So what that means is I'm taking out from the general funds of that insurance company. I'm using their $20 in the real world, and that's what allows my 20 bucks to still sit in my policy to grow and compound as if it was never even touched. You may be thinking to yourself, but Hannah, that kind of sounds like the same thing if I take a loan from a commercial bank. I could do the same thing. I could collateralize against my checking account, my savings account, and take a loan from a bank and do the exact same thing. You are absolutely right. But the difference here is who is in control of the transaction. If I were to take a loan from the bank, let's say for the $20, if I were to take a loan from the bank for the $20, I am now expected to pay them back and pay them back with interest and pay my monthly payment on time. Because if I don't, what are they going to do? They're going to come and take whatever collateral that I put up with them, whether it's my checking, my savings account, maybe it's a car, that's the collateral, maybe it's your house. If you do not pay that banker back, they're going to come and seize whatever collateral that you gave to them. The difference between the insurance company, if I do not pay my $20 back, they're going to deduct it from my death benefit at the time of my passing. So if I never pay back the $20, and let's say I have a $10,000 death benefit, I'm just using easy round numbers here. If I have a $10,000 death benefit and I never pay this $20 back, what the insurance company will do is they'll take that $10,000 of death benefit, subtract the 20 bucks, and that leftover, that $9,980, that's what's going to get paid out to my beneficiaries tax-free. It's the same, yet it's different. It's different in the aspect of I'm in control here. If something happens in my life where I get laid off, I get fired, I lose my job, I make a bad investment, and I just simply don't have the cash right now to pay the banker their monthly payment. If I'm in debt to myself, I'm not going to call Hannah up over the phone saying, hey, Hannah, it's the 15th of the month and I haven't received your monthly payment yet. Where's it at? Hannah is not going to call Hannah up over the phone saying, where is your payment at for this month? Because I'm in control. Something happens, and let's say I can't pay myself back for 6 months, a year, 2 years. It's okay because I'm in debt to myself, and I am not going to come and tow my own car off of my driveway. That's kind of psychotic and ridiculous. Would y'all agree? So who is in control of the transaction? That's what this whole concept is about. Are you controlling your cash and that pool of money of where it's being stored at? And as I'm sitting here talking, I want to bring up this book, okay? Becoming Your Own Banker. In this black book, Nelson actually gives us a visual representation. It's on page 26. Oops, hold on. There's the audio version. Because FYI, this book does have an audio form. I do like the audio, all right? But on page 26, Nelson gives us this visual representation. Okay, let me make sure. Hold on, for my Instagram people. I want to make sure that y'all can see this, okay? He talks about, number one, banking is a process. It's not about a product, okay? That's a whole topic that we can get into because people want to get hung up on whole life insurance and product. No. It's a process. What's happening is you're paying your premiums. Your premiums go into your policy, into that insurance company. When your premiums go in, they have this money pool here. And within this money pool, the insurance company they're using the money and they're making their own investments with it. But Hannah, if the insurance company is making their own investments with this money, isn't that the same thing as a bank? Isn't there some risk there with that? Couldn't the insurance company totally lose out on the investments that they're making? They could, but here's the biggest difference. You got to understand that banks and life insurance companies, mutually owned life insurance companies, let me be specific, banks and mutually owned life insurance companies, they are not investing in the same things. Commercial banks are investing in more risky investments, more risky loans, meaning providing mortgages to low-income families. They could be funding for startup companies. You don't know what's going to happen. Is that startup company going to make it, or are they going to totally flop? You don't know. They are making different investments, and they are operating on the whole world of what's called fractional reserve lending. So what that means is when you go put money at the bank, that bank can legally lend out $8, $9, $10 for every $1 that it holds on hand inside of its money pool. The insurance company is not doing that. At the end of the day, they have a contractual commitment and promise to their policyholders, because at the end of the day, it's a life insurance contract. And contractually, that insurance company has to pay the guaranteed interest, and they have to pay that guaranteed death benefit on the policy. So they're making different investments. They are investing in bonds. They're investing in bonds. They're investing in some commercial real estate. A lot of the big shopping centers and sporting arenas that y'all see around, I mean, most of those are funded by insurance companies. But they also got to keep cash on hand when policy owners, us, want to take out our cash value, because contractually, the insurance company has to give us our cash value. You, the policy holder, you, the owner of that policy, you hold first rights to that cash value that's inside of there. That's why they can never deny you access to your cash value. So they got to keep cash on hand when policy owners want to take out a loan. And they also got to keep cash on hand when a death claim and a death benefit has to get paid out. So the biggest difference here is that these insurance companies are making smarter money moves. They're looking into the future, because the insurance company, again, they have those contractual promises that they have to pay the guaranteed interest rate and the guaranteed death benefit. So they are never lending out more money than what they have on hand. For every $1 that they have loaned out in their portfolio, so look right here, look on the other side of the chart. From the money pool, the insurance company will lend out their money to policy owners. They'll lend it out for mortgages, that commercial real estate that we're just talking about. They'll even lend it out on joint ventures. Joint ventures meaning, what's the right word I'm looking for? Joint ventures meaning business, okay? The different joint ventures, business funding. And every time they make those loans out, they have the repayment of the loans coming back into their money pool. They can never lend out more money than what they have on hand. For every $1 that's stored within inside of their money pool, or I should say it this way, for every $1 that's invested into these different adventures that they're doing to grow their portfolio, grow their wealth, has to be protected by the $1 that's stored within inside of this money pool. $1 has to protect the $1 that's invested out there. Because then from this money pool, what do they got to do? They got to pay death claims. They got to pay the operating expenses of running the insurance company. And at the end of the year, when the insurance company does as expected or better from their portfolio and their investments and bringing their premiums in to the money pool, That's what comes back to us in a form of a dividend to the policy holders. The only thing that's not guaranteed inside of a whole life contract are the dividends. Dividends are not guaranteed. That's why when you're ever looking at a policy illustration, you see the guaranteed side, what has to happen, no ifs, ands, or buts, and then you see the non-guaranteed side. And that non-guaranteed side is just showing the dividend, the projected dividend that that insurance company is projecting to pay out that year. I can't sit here and promise y'all dividends inside of your policy, y'all, okay? It's not contractually guaranteed. But if you go back through history and you look at these mutually owned insurance companies that have been around since the late 1800s, early 1900s, they've been paying out dividends consistently and consecutively since then, over 120 plus consecutive years. I can speak on the 6 insurance companies that I just personally do business with, where I hold my policies with. They have been paying out dividends for over 120 plus consecutive years. How are y'all still paying out these dividends, these surplus to all of your policyholders when everything else in the economy could be up in dumpster fire flames, is what I always say. Civil War time, the Great Depression, 2008 in the housing crisis. Why are these insurance companies still paying out a surplus and dividend when everything else was not looking so pretty, not looking so hot? And it's because of how they operate their business. This is why I feel safer keeping my wealth with the insurance company compared to commercial banks. They have consistently shown and proven that they are going to remain stable. They are not going to fold in a time of crisis because they're not making the silly, goofy investments that bankers are doing by being hogs and being slaughtered every time something goes down. It's just what we've been societally taught, you know, hey, go make your money, go store it in the bank, max out your retirement accounts, and just hope and pray and cross your fingers that the government's going to take care of you. I mean, when are y'all ready to start really taking the control back into your hands? Have you really met anybody who is totally happy, elated, ecstatic with how their retirement account is performing for them? Or do you see, like myself, a lot of the people who are standing there at the checkout of Walmart, the checkout of Costco, maybe even in the drive-through of Chick-fil-A, where they look like they're of retirement age? And I've always had the thought, hey, are y'all here at your retirement age because you want to? You just want something to do? You want this part-time gig just to get out of the house, meet people, have something to do within your day? Or are you here working because you have to, because of survival, because you did not control the money pool and where you were storing your money at, and something happened, a dip went down, you no longer have that capital, and you've been accumulating the cash somewhere in somebody else's realm, in their pocketbook, and now you have to go work because of survival and you need to go put food on your table? When are y'all going to start taking the control back of your financial life? Okay, it's up to you at the end of the day. It's just like your mental health, your physical health. It's up to you to take back that control. I'll tell you, even in my own personal life, just here recently, I had to cancel some trips. I was like, I am not in the correct mental state right now. I'm feeling a little bit of burnout. It's up to me because I'm the one saying yes to all these speaking gigs, traveling around the country, meet my friends in different places. It's up to me. And so, Hannah, are you going to continue to drive yourself freaking mad? Or are you going to take control and actually prioritize yourself and treat yourself as your number one asset? Anyways, let me get a sip of water here. I see some comments coming in as well. Oh, my lovely friends. Good morning, Mr. Dexter. Good morning, Dave. I have multiple needs and wants this with my strategy, LOL. Annette, good to see ya. Connor, good morning. Alfred. Hey, real quick, we have a question coming in too. Jam 607. That not having to pay monthly gives flexibility when those I lent money to have an event. Good with negotiation ability, and I'm not stuck short on my end. Exactly. What Jam 607 is saying here is that, hey, anytime I take money out of my policies as a loan, I'm not required to pay back the policy loan. I'm in control of this transaction. I can decide when I want to pay it back, how I want to pay it back. Oh, and let me pick up my papers. My OCD is kicking in after all my papers crashed. And my lovely CD audio. Okay. So that's exactly it, Jam. We're in control of the transaction here. Believe Bible is coming in as well, saying, hey, Hannah, it's Rich from Daytona Beach. Hi, Rich. Okay, neighbor. He says, should I cash in my 403B and take the money in case the market crashes? I'm never going to tell y'all what to do. All right. This is up to you in your financial life. There's a lot of factors that weigh into this. You know, how old are you right now? Age is a determining factor. I spoke with 2 people this past week who are age 58, and they have dollars inside of a qualified account. And I'm like, look, y'all, you are so close to age 59 and a half just by avoiding the penalty. If it was up to me, I think I would just wait the year and a half till you are 59 and a half to avoid the 10% penalty. And then at that time, let's talk about it, because you have to pay tax on this money. When you are putting when you are putting money inside of an account where it's pre-tax dollars, you're just delaying the time of when you have to pay the tax on the money. You always have to pay the tax on the money. Are you going to pay the tax later, or are you going to pay it now? So the question I would really ask yourself is, number one, what are you currently doing within your financial life? Do you have a need for that capital? Because let me tell y'all something about this. I was talking with somebody just this week. She has a boatload of debt, a whole lot of debt, and it's a lot of credit card debt. Right now, she is paying over $18,000 a month just in credit card debt. And a whole lot of that is just into interest. When I asked her how much interest are you paying on that credit card debt, she tracks it now. $5,000 to $6,000 a month is just going to the interest alone. But you know what's funny is she also told me, well, hey, I'm also taking $10,000 a month and I'm putting it into this Charles Schwab account. And this Charles Schwab account is giving me $1,000 each and every month. Make the math make sense, y'all. If you had that money, would you rather go and pay off this consumer debt to free you up $18,000 a month? Or do you want to continue to grow your portfolio and make the $1,000 a month? But it's just what we've been taught. Like, I get it. And I know, again, I know people aren't in this world day in and day out. But you got to make the math make sense. The math is not math in here. So Believe Bible, my question would be, what are you currently doing in your financial life? Is it debt payoff? Are you accumulating capital because you want to have tax-free income? Sorry, that just came out naturally. That's what we use the policies for. But are you accumulating the capital because you want to have that money for retirement? Are you storing the money here because you're looking to do a down payment, buy a house? You got to pay some taxes. You want to take a vacation. You want to take your hot spouse on all the dates that they deserve. What are you doing right now? That would be my first question. What are you currently doing right now? What are the needs and the goals? And are these specific accounts allowing me to accomplish these needs and goals? So Believe Bible, this is where in my mindset, is it important to accumulate cash somewhere? Absolutely. Abso-freaking-lutely, it's important to accumulate cash somewhere. But it's more important to have the cash flow that's coming in. So in my opinion, and this is what my mama did, okay? My mama had a 401k when she was working with the government, all right? She was a nuclear engineer for the Navy back in the day. And when Dad first started implementing this concept back in 2008, it actually took my mom 2 years to be fully on board with all of this. And by 2010, mom just totally ripped the Band-Aid off. She says, you know what? It makes more sense for me to use my money today, use my good dollars today. Because here's the thing, money is nothing more than just a means of exchange. That's all money is. You take your money, you go buy food. You go buy your cars, you go buy houses. Money for food, food for money. Money for car, car for money. Money for house, house for money. That's all that money is. You would never take your money and go buy yourself a car or a house and then wait until you're 59 and a half to drive the car or move into the house. That would be kind of stupid and ridiculous and crazy, would it not? So why are you doing that with your money? So in my opinion, I would really look at what you're doing right now within your financial life and believe Bible. Seriously, if you want to have a conversation with me, send me an email, okay? Hannah@themoneymultiplier.com. Hannah spells the same ways forwards and backwards. Hannah@themoneymultiplier.com, and we can have that one-on-one conversation together. But if it makes more sense, because you're going to have to pay the tax on the money anyways. You're just kicking the can down the street on the taxes that you got to pay. And a lot of the times, y'all putting money inside of those qualified accounts, you need the money right now. You're drowning in some of that debt, or you have a large tax bill that you need to pay, and you're just kicking the can down the street on inside of some of these qualified accounts of where you're storing the money at. So does it make more sense? Should I maybe rip the Band-Aid off like my mama did? She ripped the Band-Aid off. She took the tax hit. She took the penalty hit. And then she got the money inside of the policy. And to be honest with you, we've just never looked back. Actually, matter of fact, right now, we're starting even more policies on mom and dad. I got them in underwriting right now, which, by the way, Dad, if you're listening to me, you got some stuff that you need to do for me, bro. You know your worst clients? Let me tell you something. Your worst clients are your family members. Y'all are tough. Anyways, Dad, if you're listening to me, you need to holler back at me because we got some stuff to do. But what you can do is I would really talk with a tax professional too, because if it does make sense, number one, I would hop on the phone with me first. Okay, so hop on the phone with me first would be number one. Let's talk and strategize about what you're currently doing, because there's no one silver bullet. Everybody's different. And then number two, if we do come to the conclusion that maybe it is a smarter idea for me to use this good money today because I have a need for it and I want to get myself into a better financial position, does it make sense to take all of it out right now? Or maybe I take half of it out this year and half of it out next year, so then it doesn't bump me up to that next tax bracket. So that's what I would look at if you are starting to take the distributions out of the policy. Out of the qualified accounts. If you are taking the monies out of the qualified accounts, is there a penalty, and what's the tax going to be? And is there a smart way where I could take the monies out by not bumping me up to the next tax bracket? That's what I would personally look at. I'm going to leave this comment up here because Dexter's calling me the boss. All right. And Justin, good morning, my friend. Good to see you. Okay. Life insurance, or I should say, investing is about growing the assets, and life insurance is about protecting and controlling the capital. Every dollar needs a job. And in my opinion, every dollar should have a purpose. Some dollars you're using it for your emergency funds. Some dollars you're using it for your investments. You're creating the cash flow. Some dollars you're using it for legacy, and other dollars you may be using it for income replacement. And one tool can't do every single job. However, can I enhance what I'm doing? In the policy, this is the place of where I warehouse and store the money. Through the policy, I can make my investments, and I can even have income replacement out of my policy. Go to my YouTube channel and go underneath the lives and go rewatch the last live stream that I did a few weeks ago where I got into, I titled it Stop the Bleeding and we got into Aunt Irma, the Medicare, Medicaid premium payments that we got to make when we're in our latter years. But go watch that example of how we're using these policies to supplement income. In my opinion, the policy is a place to enhance what I'm already doing. It's not to replace what you're doing. It's not the either or. This is my and asset. It's a place where I can store money for emergency funds. It's a place where I can leverage and use the cash value to buy the investment, having my money work even harder for me. Because policy loans, remember, we're not withdrawing the money, we're taking out loans. And when I'm taking out the loan, I'm using the insurance company's money in the real world, which then allows my money to still sit there to grow and compound as if it was never even touched. I'm making my dollar have multiple jobs and multiple duties instead of just being in one place, earning me in one specific vehicle. You can't just compare the investments versus life insurance. You know, life insurance is a place to protect and warehouse the wealth. Your investments are your investments. It's like having a toolbox and your hammer or your saw, your wrench or your drill. What one is the best tool to complete the task on hand? It just depends on the job. I don't go out and buy a hammer because it's better than a saw. I buy it because it's designed for something different. They have different uses in different places. I'm going out and I'm investing in real estate. I'm putting money back into my business. I'm doing my private lending. But before I go and deploy my capital, I'm warehousing it inside of my banking system. My policy isn't replacing my investments. It's making me a better investor and a smarter investor. And I'll tell you one thing that my dad has actually said, because if you've ever come out to any of our live events, the Money Multiplier Masterminds that I've been putting those things on since I was 19 years old. This year is the first year where I took a break and I didn't host the Money Multiplier Mastermind. We may be back in 2027. Let me know if y'all want me to continue to do those. They really started doing the events because I just thought it was a good place for all of us to come together in one location and be with like-minded people who are doing this. Because if you ever go out and you talk to your colleagues, your coworkers, or family members about what you're doing with the infinite banking concept, they kind of look at you sideways and they're like, what in the hell are you doing? Are you sure you used to be doing that? Life insurance is just life insurance. You can't be using it for the cash values. That's stupid. But anyways, if you ever come out, like last year, we were out in Denver and Dad went through his portfolio of how he's been using his policies to build his wealth and make the different investments. And Dad has made some mistakes, you know, in the investment world, there's risk there. And Dad has some non-performing loans out there. And I just always think back to this one-liner that he said. He goes, you know, it sucks. Like, yeah, it sucks losing money, okay? I worked hard for that money, and it effing sucks when I lose that money. But you know what's cool about this whole system is I never really lost that money at the same time because I'm still earning guaranteed interest and dividends on that money in my policy, even though that investment didn't pan out how I wanted it to. I'm still continuing to earn interest and dividends on that money as if it's never left my policy. So I didn't totally lose. It sucks, yeah, but I didn't totally lose because I funneled it through my own banking system first. And I think this is where people just get confused because y'all are asking the wrong questions. The wrong question is, what's the rate of return? The better questions that y'all should be asking is, can you access your money? Can you access the money? Your money in your 401k, your IRA right now, can you truly access it? Or do you have to jump through all these hoops just to access the money? Do you control this account or does somebody else control it? Can you leverage the money? Kind of back to the access question. And then what happens if you die or graduate or pass away? What happens if the market crashes? Can that account provide you tax-free income? The wealthy families are not just owning one specific asset. They own systems. They have different pools of their money. They have the system of having the cash somewhere, having a business, having insurance, having real estate, having equity. Each one serves a purpose. I don't ask my life insurance to outperform my real estate, just like how I don't ask my real estate to replace my emergency funds. And this is where and why infinite banking is different. We're not buying life insurance because we're chasing returns. We're buying a banking system. We're buying control. We're buying certainty. We're buying guarantees. The life insurance policy simply happens to be within that chassis that allows me to do these multiple things. Kind of funny why Nelson calls this the infinite banking concept, infinite, infinite, infinite. And I've never once purchased a life insurance policy because I thought, wow, this is going to totally outperform the S&P or outperform my real estate deal. I've purchased my policies because I wanted more control. I wanted the liquidity. I wanted the options and the ability to capitalize the opportunities when they showed up. A lot of y'all had opportunities come across your desk, but you are totally locked up and illiquid right now because you locked it away into somebody else's control and you do not have access to that money without jumping through the hoops, paying taxes, paying penalties. And I don't want that. I want the control over my financial life. So I'm going to ask y'all some questions. Where does your emergency money live right now? I use my policies for my emergency funds. Personally, I have in total 6 months of my expenses. 6 months of my expenses stored as my emergency funds. And what I do is I break it up. I keep 3 months of my expenses in my policies, and I keep 3 months of my expenses inside of my checking account. And any other money, if it is not loaned out in different investments that I'm doing working for me, it is stored back inside of my policy. Where are you storing your emergency money at? Could you access that money tomorrow if an opportunity came along? What if the market dropped by 40% tomorrow? Would you still be able to invest with the dollars? And really, does your financial plan give you more options, or is it giving you fewer options? How is the money being invested? I know a lot of y'all who have like IRAs and 401ks, you love the policies a little bit better because you can actually choose where to invest the money. And I know some of y'all who are using like self-directed IRAs, you like those because then you can self-direct the funds and how they're being invested. And I get that. But I do not want to be limited to what I can use my money for. There have been times where I needed to access my money for specific uses. And if I had that money inside of a self-directed IRA, I couldn't use that money. We got to stop comparing the apples to the oranges. Life insurance is the protection. It's the warehouse of your wealth. Investing is the production. How can I go put my little green men to work even harder for me? And you need both. Your investments should grow your wealth. Your banking system should protect your ability to build it. There's no one single asset class that you should have. You need to build on top of it. When I think about this in my own life, in my own mindset, I think about my policies as the foundation to my life. This is the warehouse of my wealth, where I'm storing my capital at. Through my policies, I'm buying the investments, I'm buying my insurance, I'm buying even long-term care insurance, right? Control over your money isn't about the rates of return. This may be the most valuable financial asset that you can own, but you're in control of it, and you got to make sure that you are being a steward of your money well. That came out a little funky. I think what y'all are picking up what I'm putting down. But the goal isn't to find the best financial product. The goal is to build the best financial system. So stop asking whether life insurance is a good investment, because it's not an investment. Start asking whether your financial system gives you the control you need when life doesn't go according to plan. So if I were to ask you, if tomorrow you had the investment opportunity of a lifetime, would your current financial situation and plan help you say yes? Or would it force you to say, I can't get to my money, what should I go do about this? It just seems like I can't go do this investment now. So I don't know. I hope that clears up like some confusions. It's not, there's no either or. This is about your and asset. This is, again, just a place of where I'm really warehousing and storing the dollars at. Okay. Let me see. Believe Bible came back. I feel like if I took out 30% hit on taxes and penalties, the market crashed 50%, I would be ahead by 20. You're thinking in the correct direction. All right. Dexter's wanting another reunion with the money multiplier. Oh, shoot. I went long today, y'all. I got a meeting here at the top of the hour. Okay. Hold on. Before we go, he says, thanks, Hannah. I'm at work. Got to go. I will email you. Good, my friend. Dexter's saying, you have to ask your daddy if you can use your money in those accounts, just like the bank. I used to hate when they would ask me why I need the money. That's it. And the insurance company's not going to ask you what you're using the money for, when you're going to pay it back, how you're going to pay it back. So, okay. I'm eating my breakfast this morning, having some fruit with me. Take care of yourselves today, okay? Reach out to me if you got questions. I'm going to be back next week for another episode. Don't know what we're talking about. I'm just always thinking of specific topics that are heavy on my noggin for the week and the conversations that I'm having. So please let me know if there's a specific topic that you want me to get into. You can send me an email, hannah@themoneymultiplier.com. But until then, do well, be good. Don't do anything I wouldn't do, my money multiplier family. And until next week, mwah, love y'all.